Next up, let's talk about selecting time frames. So it's frequently said that traders should focus on specific time frames depending on their trading style. And it's commonly said, if you're scalping, you should only use the 5-minute chart. Or if you're swing trading, you only want to use the 4-hour or the daily or something along those lines. And for those who are unaware, there's different types of trading approaches in terms of how long you're holding your trades. For scalpers or scalping, it's a short-term trading strategy. It involves taking small profits from small price moves very frequently. So every single time price moves up a percentage or goes down a percentage, you're capitalizing on that. Then there's day trading or intraday trading. This is another short-term trading strategy. It mainly focuses on entering and exiting positions on the same trading day, not holding positions beyond whatever you consider a trading day. Since crypto is a global market, it runs 24 hours a day. There aren't set limitations that we have previously seen in traditional markets, such as stock exchanges and whatnot, where the exchange was only open for 8 hours a day. And then finally, there's swing trading, which could involve short to medium term trading strategies where it focuses on catching market swings or shifts in the market that play out over days or weeks. Right? And these are just some examples. Now, it's reasonable for scalpers or intraday traders to focus on lower time frames, such as the 30-minute or 15, and for swing traders to focus on higher time frames, such as maybe the 4-hour or the 6-hour. But there's no reason to ignore other time frames. Doing so is limiting yourself, especially as you advance. For beginners, sure, if you want to just focus on a handful of time frames, and as you learn to get comfortable reading markets and whatnot, yes, sure, that can be advised. But as you become much more advanced, it's not advised to ignore a time frame or ignore a time frame because I'm only a swing trader, or I'm only a scalper, so I'm not going to look at the daily. That's you're leaving out half the picture, so to speak. So in this instance, lower time frame traders, such as scalpers, day traders, they should view the lower time frame through the lens of the higher time frames, meaning that you should consider, where is price coming from? What are key high time frame support or resistance levels? How does that relate to what's going on the lower time frames? Really starting off with the higher time frames, such as the daily or the weekly, and working your way down. That way you can have a bird's eye view of the market and narrow in and focus in as needed. It's also advised to not get trapped in a single time frame. You don't necessarily want to be the person that only trades the 1 hour. I only trade the 4-hour. That's limiting yourself, because not all opportunities will arise on those particular time frames that are actionable. Sometimes you might have gotten an early instance on the 1 hour time frame that could have supported an idea that you may have been anticipating on the 6-hour. That way you could have used that 1 hour time frame trade idea to help execute and as an entry based on your larger time frame idea, larger time frame concept. You also don't want to limit yourself to only identifying levels and trends on the hourly chart, or only looking for trade entries only on the 15-minute chart. Have an open mind. Remember, each one of these time frames it's just different ways of looking at the same asset, different ways of looking at the same data realistically. It's just how zoomed in are you, right? We don't want it to only be super zoomed in or only be super zoomed out. We want to have flexibility and have an open mind and have a wide range of perspectives on the market. So here's an example on TradingView. This is Ethereum to US dollar. This is the daily chart. And what we're going to do is we're going to map out some key levels on the daily chart and compare that with how it may look, let's say, on the 15-minute chart, which looks like this right now. So, we could zoom out and see maybe a month's worth of data on the 15-minute chart, but how actionable is this data, right? By looking at these larger time frames, such as the daily, we get a much bigger picture, and we're able to have a better reference as to where we're coming from and where we're going to, and use that to help inform our scalps or inform our intraday trades that we're going to use on the 15-minute. So let's say our most recent candle, we're here. Currently the price is 3,100. So let's say we're coming from here. Where could price go to? So first, what we could do is we want to map out maybe some sort of support level or where we're coming from. Let's say around here. This seems like a good place to draw this. So let's say price came to here. It bounced off this daily support, and this is confirmed and reaffirmed by looking at what else happened at this level. So this is about 2,900. We could say 3,000 if we really wanted to, and this does line up with our thesis, right? This is a significant level of support and resistance. We see it acting as resistance here when during the May 2021 downtrend. Price fell below it and was rejected multiple times. In August, price rose above it, broke out above it, and used it as support. We also saw it here in September, where pretty much price stayed within this range, failed to meaningfully close below it. There's several wicks below, as we see. Not a lot of candle closes below it, just really just one that came down to about 26.51. But overall, we could infer this as a meaningful support, level of support. And the same thing here. We do see a wick down to here, to this 29,000 level. And it seems to be a level of support, once again, falling here to a low of recently about 28.30 and reversing back to the upside to currently about 3,100. Now, this is where price is coming from. Where could price go to? Well, the most recent high is observed here at 32.84. So let's say we were to drop a line there to say, well, this is a significant level of resistance because price came up to here. It was rejected down. It fell to support, and the support held. The support did its job. So, and if we draw this line here, this line's up about 32.84. We could say 3,300. Remember, none of these levels are fixed numbers. It has to be 3,000. It has to be 3,300. They're flexible. It's subjective, and there's a bit of give, right? It could go a little bit above it. Price could go a little bit below it, right? So let's say we drop that here. Well, it looks like this lines up pretty well. Price came up to here. It fell down to this line. This worked out as support. This worked out as meaningful support. It looks like price did recover for one brief candle, but there was a great amount of bearish and sell-off pressure in May in 2021. So this was a meaningful bounce observed on May 18th, so this could be considered as well. We do see a significant range trading from early August, pretty much throughout all of August 2021, range trading between these two levels, which we've mapped out, and so on. There's multiple instances, so both of these levels are valid. So where could price go realistically on the daily chart? Price could probably come up to here, and this is where we want to see if this potential market break, this potential market reversal to the upside will continue. So let's see, how can we take some action on this, let's say on the 15-minute chart. If we go to the 15-minute chart, well, now we're painting a much clearer picture of where price could go, because now we see the 15-minute and these various levels of the 15-minute in the context of the daily. Now we know that, well, here are my daily levels, right? We're pretty much smack dab in the middle of two daily levels. So probably right now wouldn't be the best time to enter any position. The best time if you were focusing on the 15-minute, probably would have been over here, because here we saw price came down to this significant daily support, and even though price did close below it for a period of time, maybe a few hours, if we go back to the daily, zoom back in on the daily, there was no significant or notable candle close below this level. Remember, it's not just one level. Oh, price came down to 28.36. That invalidates this. Not necessarily. There's a bit of give and go with support and resistance. Remember, it's not just one fixed level. So now, in regards to the 15, now we have a much more actionable plan. Well, if price comes back down to here and produces some sort of higher low, right? So here is our most recent low after reaching this range. If we produce some sort of higher low, maybe let's say around 29.50 or so, or yeah, because we could say this is a level of support on, or a level of resistance, and we could even make this smaller. We could even color code it on the 15. Let's say price comes down to here and this acts as support. Well, this could now be used to help inform my 15-minute trade, because now I know that, well, we're still in the context of this daily range, we're still in this daily support, and I'm not just only relying on the 15-minute, which could be perceived as a weaker time frame. It's not as strong as the daily time frame, which is a more dominant time frame. Next up, let's take a look at time frame dominance. So part of using a multi-time frame analysis method is to help you identify the market. And in this case, we want to identify the current trend and trade with the trend. Now, the question is the market in an uptrend? This is when you want to long or buy the asset, because this is more likely to be successful as there's an established trend of higher highs and higher lows. Prices gradually moving up. It doesn't need to just go straight up. We're seeing these periods of higher highs and higher lows. Now, if the market is in a downtrend, we assume the reverse. This is the time to short the asset, as it may be more successful as there's an established trend of lower highs and lower lows. Price is descending, and once again, it doesn't always have to fall off a cliff and go straight down. Sometimes there's peaks and valleys, but in a descending pattern. Now, sometimes this isn't always helpful, as there is often more than one trend occurring in a market depending on what time frame is chosen. Sometimes you might see a downtrend on the lower time frame in the context of a larger uptrend on the higher time frames, and vice versa, right? Similar to our previous example on Bitcoin on the weekly versus Bitcoin on the hourly in the same time period, this late June time period. Price establishes higher highs and higher lows on this hourly chart on the bottom during a very obvious a weekly downtrend, right? Price is noticeably on a downtrend. We're seeing lower highs, lower lows, and consecutively, candle after candle for the most part. And this is really contrasted in this particular candle. We see this pretty large wick on this one candle. This is made up of all this price movement of from the 22nd to the 30th of June. And here we see probably from this bottom price ascending back upwards, but not necessarily in a meaningful fashion. Yeah, price did not completely capitulate here and keep ascending down. It came back up near its open. But generally, the overall trend, the overall market structure, when looking at the larger time frame, we see that it is still downwards. Continue with identifying the environment. So part of identifying the environment is figuring out what is the dominant trend and what conditions would allow for the best positioning within that trend. Remember, we want to trade with the trend. We want to swim with the current. You don't want to swim against the current. Don't trade against the trend if you can help it. Try your best to trade with the trend, as that will be most beneficial, and you'll see the best results consistently. So generally, dominant trend is found on the higher time frame charts, whether that's the monthly, weekly, daily. Whenever I look at analysis, I want to analyze a new asset or even just something that I'm very familiar with, such as Bitcoin, Ethereum. I always start with these larger time frames. I start with the daily, or I start with the weekly or the monthly, just to see what the general trend is telling me. Now, if a dominant trend is identified on the higher time frames, then signs of a real reversal must also form on the higher time frames. So signs of a real reversal or signs of an invalidation on my trade idea or the invalidation of that trend also has to come on the higher time frame. Remember, if you have found that the higher time frames are indicating a downtrend or a bear market, signs of a reversal or invalidation of that bear market and a shift to a bullish market structure, that will only come on that same time frame, the same higher time frame. That's not going to come from a 1 hour chart if you found that things are in a downtrend on the daily. And going along with that, once again, a single or multiple green candles on the 30-minute chart is not a sign of a reversal of a weekly downtrend. Don't chase a reversal unless you have good reason to do so. You really want to have strong reasoning, strong evidence, and remember, if it's something that's happening on the weekly, it's going to take weeks, right? Higher time frame trends last longer than lower time frame trends. They take more time to play out and resolve. It's best to consider a dominant trend in play until it is clear that it's not. And there's a very famous quote that's said in trading circles: the trend is your friend until the end, right? So once again, you want to trade with that trend. You want to acknowledge that trend is as long as it's valid and hasn't been broken. But once it's clear that it's broken and that it has ended, it's not your friend anymore. Don't trade with that trend. If it's obvious, I think this is the most common application I see this in is when the market shifts to a downtrend and people are still longing and really trying to force some sort of market recovery when it's clear it hasn't. Remember, if the trend has ended, that's it. It doesn't matter how much you try to buy the dip or short the top. Trade with the trend. It's really advised to just consider the dominant trend. If you see signs of the dominant trend reversing and it's clear that it has reversed, especially on the higher time frames, that's when you shift your trade bias. Now, lower time frame moves against a dominant high time frame trend are considered counter trend trading, or what's commonly called as fading. So let's say if we have a bearish high time frame market structure, any broken support is likely to turn into resistance. So, and this is where you would short or sell the rally. So let's say Bitcoin is coming down and it hits 40,000 and it falls below 40,000 and it drops down to 37,000. Now that $40,000 support level, that's likely to turn into resistance. So if Bitcoin does reverse back up to that upside, and let's say there's some sort of rally where price goes back up to 40,000, that's a good place to short or sell the rally if we're in a confirmed higher time frame bearish market structure. Now, in a high time frame bullish market structure, broken resistance is likely to turn into support. So let's say Bitcoin is in the 30,000s and it breaks past 40 or 42 and it falls back down to 40, right? And that happens often. There's a large pump and then there's a pullback. This is normal in markets. That broken resistance, that 40K level, is likely to turn into support. And this is when you would buy or long the dips. So here are some visual examples of this in play. So here's our downtrend. Remember, the downtrend doesn't need to just be in a straight line down. We're looking for a series of lower lows, lower high, prices coming down from some higher level, lower low, lower high, lower low, lower high, and so on, right? This pattern. In a downtrend, it's advised to short or sell the rally. So whenever price establishes a new lower high and maybe reaches some sort of meaningful higher time frame structural or higher time frame level, that's a good place to consider shorting the rallies. In an uptrend where we have an established pattern or a clear pattern of higher highs, higher lows, this is a good opportunity to buy or long the dips, where if we see this new higher high and then price corrects and establishes a higher low, good time to buy the dip or long. And same thing, and you would continue this pattern until the trend ends, whether it's trending downwards or trending upwards. Now, following this mindset, this strategy, even if you quote unquote lose or get stopped out on the last trade, you still caught the meat of the move. So let's say we're in this downtrend and price keeps going down, and price, let's say, forms this low and it comes back up to here, and you short again, right? But instead of coming back down to an even lower low, it falls above your entry. It falls a little bit lower and then breaks out and produces some sort of market structure break and reversal. Even if you lose, as long as you had proper risk management, you had a reasonable stop loss set up, and you lost a little bit of percentage on this trade, you still made out on 1, 2, 3, as many of these downtrend rallies that you capitalized on. As long as you used proper risk management, you caught the meat of this move. You caught most of these rallies and you shorted them. Same thing with the uptrend. I find more people are much more, they're much quicker to long dips. Remember, we want to long dips in an uptrend. We don't necessarily want to buy dips in a downtrend because we don't know where the bottom is, right? We don't know. And the overall direction, especially if we're looking at a higher time frame, is down. So we don't know if we bought this and this is the bottom, or if this is the bottom, or if this is the bottom, or if this is the bottom. So we don't know when this ends until we have clear indication that it has actually ended, and vice versa. We don't know when the uptrend ends until there's clear indication that the uptrend has ended. For more information on overall market structure and shifts and breaks in the market structure, be sure to check out our advanced market structure lesson.